and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. Well, during the past few weeks, we've seen a spate of articles and reports on the global financial crisis. The seismic events that followed the collapse of the US-based investment bank Lehman Brothers 10 years ago, on the 15th of September 2008 to be precise. Virtually everything that could be said has perhaps been said. Those who don't learn from history are doomed to repeat it, said writer-philosopher George Santayana. Yet the very fact that there's been such an outpouring of comments suggests there's still no unanimity either on what led to the bankruptcy of the once iconic investment bank or on whether we've learnt the right lessons. So in this edition, we're going to try and take a dispassionate look at Lehman and after, and wherever possible, try and bring in the Indian perspective. And to help me do that, I have with me a stellar panel. T.T. Ram Mohan, economics professor at IIM Ahmedabad, H.R. Khan, former Deputy Governor, Reserve Bank of India, and Obik Barua, chief economist at HDFC Bank, to give us a 360-degree view from the academic, regulatory and the banking perspective. Welcome to the show, TTR, Mr. Khan and Obik. Let me start by asking each of you in turn, what would you identify as the three main reasons for the collapse of Lehman? The excessively loose monetary policy of the Fed in the years before, the failure of regulation, greed of bankers, the list is endless. So let me start with you, TR. Just the three main causes to your mind.
Well, I have been fairly clear in my mind that while you could, the number of causes led up to the financial crisis, the principal cause was failure of regulation. So there is no doubt in my mind that the failure of financial regulation is the principal cause, because all the other causes that people have cited, such as macroeconomic imbalances, greedy bankers, inadequacy of rating agencies, whatever other causes you can think of, and there are as many as 25 causes that you can find on the net. See, all these causes have existed in the past, either singly or collectively, without bringing on a major global economic collapse of the kind we saw in 2000, 2008. And therefore, I would say that those causes singly or collectively cannot explain the magnitude of the crisis that we saw. And mainly the problem was a failure of financial regulation, which is the inability to prevent a systemic bank failure, which of course is the result of failure of number of regulations, which we can go into a little later. But yes, but to answer your question, that's regulation, financial regulation was the principal villain.
Khan, TTR talked about poor regulation as being one of the key factors for the crisis, and the fact is that fracture and poor regulation is often seen as one of the main reasons why US authorities remain blissfully unaware of the problems building up in the system. As a former regulator yourself, would you agree that regulators have a lot to answer for when there's large-scale failure? And despite that, both in the US and closer home in India, regulators seem to have got off relatively lightly. In all the comment, you don't see much criticism of regulators. Why is that so, Khan?
No, there is some element of truth that there were some lapses in the regulatory framework. But to state that that was the principal reason is like telling the policing is not perfect, that is why the crime is high, but the whole tendency for crime, we should look at why crimes are happening. Policing has to certainly improve, but what are the underlying conditions leading to crimes, that one has to see. So similarly, we have to see the structural reasons why led to that. Just to list a couple of things which comes to my mind immediately is, of course, the whole focus of over financialization, the financial sector running ahead of real sector. So that was one reason. Of course, you can't discount the impact of both external imbalances and internal imbalance. Lot of talk has happened about external imbalance, macroeconomic imbalance. Internal imbalance, for example, US, lot of unemployment and inequality was happening. So they wanted to bring financial inclusion in the name of cheaper credit for the housing sector, so that inequality is removed. So that is one reason. And third, of course, not focusing, balancing between stability and innovations. A lot of fellows with engineering background and model background come to the financial sector. They thought model is the ultimate nirvana, and through that they can bring out financial sector revolution without looking at the structural issues and the fundamentals. I think these are some of the reasons I think over and above some regulatory gap which caused this crisis.
I'm so glad to hear you say that, Khan, because I also am strongly against all these astrophysicists zooming into economics and telling us that they have all the answers when you're dealing with human beings. But Obi, could you like to add to that list? And between the macro and the micro factors that led to the crisis, which do you think really lay at the root of the problem? And the reason I ask you this is that though it is a commonplace in India to blame the bankers for rising NPAs, the fact is that the Reserve Bank of India's excessively loose monetary policy, successive relaxation of exposure norms, apart from exhorting banks to lend, were as much responsible, not just regulation. And this is something that Raghuram Rajan has now admitted. Would you agree that it was a combination of factors, and which are the three main that you would like to zero in on? Obik?
No, absolutely. And I think Mr. Khan touched upon the fact that I think the roots of the 2008 great financial crisis partly lay in politics, and it sort of goes back all the way to George H.W. Bush's time, the late 80s and early 90s, where there was a conscious effort to dilute lending norms for housing. There were a number of changes in the way Freddie Mac and Fannie Mae, the big refinancers in the mortgage market, operated. There were a couple of other significant changes. But I think the attempt to handle problems such as rising inequality, stagnant median wages, and sort of distract from that just by offering cheap credit to enable one to fulfill the great American dream of owning your own home, I think was a major sort of a political root of this crisis, and this sort of snowballed into a lot of unnecessary innovation, dangerous innovation perhaps is the right word for it, and things like that. But I think the element of politics, I think, has been underemphasized in the narrative on the great financial crisis, except for people like Dr. Rajan. But I think that's important because that resonates very well in the Indian context, where there is often, if you look at the genesis of a crisis, intervention from the political side to do things that are not in the best interests of either the financial system or the corporate system or whatever. And I think that really is something that strikes me. And of course, there are the obvious ones that I think economists need to take the blame for the fact that there was this notion that price stability is the mantra for everything, and price stability automatically leads to everything else, including financial stability. I think that was a rude shock for economists, and they also need, along with regulators, need to take the blame for it.
Sure, lots of people to be blamed, and that's why economics actually was first called political economy, because politics is very important. But TTR, one of the main learnings from the crisis really is that when the chips are down, textbook orthodoxy must be junked, and monetary and fiscal policy must do whatever it takes, to quote the ECB's Mario Draghi. So the Fed balance sheet grew remarkably 3 times almost, and the US government deficit also touched close to 10% of the GDP. Had an emerging market economy attempted to do anything remotely similar, Western authorities were to come down very heavily. So is it that there's always one rule for the US and another rule for everybody else, as we're now seeing in the context of global trade? TTR?
Well, yes, I think that's true that the advanced economies don't always practice what they preach to others. But I think the tools to respond to the crisis have been well learned since the Great Depression. And so fiscal expansion and monetary expansion, and also the swift recapitalization of banks, which happened very swiftly in the US, but not so swiftly in Europe. And so the contrast in policies partly explains the contrast in outcomes, which is that the US recovery was much faster than the recovery in Europe, because in Europe the coordinated action which was needed to recapitalize banks and the finances required for the same were not forthcoming. So I think these are the standard responses, but I would emphasize that the most important thing is to prevent failures of these kind in the first place, because we have learned how costly and how difficult it is to correct once the failure happens. Don't forget that more than a decade later, we are not even sure that the recovery is complete, in the sense that the affected economies have returned to the pre-crisis trend output. It took the US, I think, about 7 or 8 years to come back to the pre-crisis level of output. But what you should look at is the output level they would have reached without the disruption caused by the crisis. Many of the economies of the world, including the advanced economies, are still away from that point. So the massive loss of jobs and incomes and the political consequences which have unfolded, in the most unpredictable ways, various manifestations that you've seen, anti-immigration policies, Brexit,
Sure.
the rise of Trump and protectionism in Europe, the move away from multilateralism, the unfolding consequences, and therefore, I think the focus should be less on how to respond to the crisis than to prevent a catastrophe of this kind in the first place.
Sure, prevention is better than cure, but it's never very easy. But Khan, another key learning is that speed is of complete essence. One can't afford to dither. Within days of the collapse of Lehman, US authorities set up the 700 billion TARP, the Troubled Assets Relief Program, and with bipartisan support to rescue not just financial instruments, but even entities like AIG, the insurance major, and General Motors. In contrast, we in India have dithered, whether in setting up something like TARP or in recapitalizing our banks, even as political parties are forever taking pot shots at each other, all of which could prove very expensive as Ras Khan. Isn't speed of essence, and why are we so slow to react? Khan?
Yeah. Now we had an example when we did for that UTI, we had done something for stressed assets of IDBI bank. I think there are examples of that. I think it's a valid point. We are now, because the IBC has come, people think the IBC is the nirvana for all. Certainly it's a great, great instrument, but you can't put all your eggs in IBC. And if you want to, along with governance reform and other required changes in the banking system, for legacy issues, I think we have to think of that structure. I think bad bank is not really a bad idea if it is done properly with proper management.
Okay, you're very right on that, Khan. But Obik, the fact is that the US Fed is credited with what it called unorthodox monetary policy or quantitative easing. And it is often spoken of as though it was something that was entirely original. But is it really? In the good old days, we'd have called it for what it really is, deficit financing. How is it that the Fed managed to pull it off? Isn't it a bit like the emperor's new clothes, except that there was no little boy to call the Fed's bluff? Also, does the fact that inflation remains so low and for so long, despite the massive infusion of liquidity, suggest we need to rethink received wisdom on both inflation and inflation targeting frameworks? Obik?
Yeah, I would think so, but I think I have slightly more regard for the efficacy of the 3 rounds of quantitative easing than some others. And there was an extant literature based partly on the experience of the Great Depression with contributors like Dr. Bernanke on what should be done when interest rates come down to what's referred to as a zero bound. So it wasn't sort of that maverick an idea, and it had its roots in whatever economic theory and analysis. I would tend to agree with you that the central bank needs to be nimble, and both the recapitalization, the alacrity in recapitalization and unleashing QE was an example of the US policy establishment's quickness in responding to the problem, and I certainly think there is an issue with that here. Having said that, I would sort of link this to the earlier point that you were discussing with Mr. Khan, is that anything, I mean, this is a sort of a political, social, cultural factor here. Anything that is seen to involve too much innovation tends to become controversial, and the default option, the least controversial option, is to sort of push it through the judicial process, and that's what the IBC does. And the judicial process has its own problems, as we all know. It's a hugely cluttered up process. It has a large legacy of cases that are still pending. So if you, it's a sort of a choice between the devil and the deep blue sea. Either if you did a bad bank and you sold it at a price that someone piped up and said that wasn't fair, then you open up a whole can of worms. If you want to sort of do it through the IBC NCLT, then you will face the problems of a very sluggish judicial system. So I'm not really sure what the right answer really is. But I think there are a lot of supporters for sticking to the IBC to avoid potential controversy going forward. And we do have our fair share of controversies in the financial and banking system.
Oh, that's very true. But I'm afraid it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing Lehman and after. What are the challenges? What has the world learned? With three experts, one from academics, one from central banking, and one from the field of pure banking. TTR, the fact is that the International Monetary Fund calculates that between 1970 and 2011, the world has suffered as many as 147 banking crises. So is there something that is inherently wrong with the modern banking model that makes both crises and the use of taxpayer money inevitable? So the best that we can do is minimize the frequency and the intensity. You spoke of prevention, but is it really possible? Can we do that ever? Because it's all very well to say taxpayer money must not be used to rescue banks and bankers, must be made to pay for their sins. But in hindsight, would less taxpayer money have been spent all over the world had the US rescued Lehman rather than try to test the too big to fail hypothesis by allowing it to go? TTR?
Well, yes, I think more and more evidence is coming up which suggests that the decision to allow Lehman to fail was a bad one, particularly because just a couple of weeks later they had no qualms about bailing out Goldman Sachs and I think Morgan Stanley. So they tried to test out this hypothesis about allowing one big bank to fail, and the effects were so disastrous that they were quick to respond. So I think that was a bad decision. But to address your question about recurring financial crisis, I think financial crisis will keep recurring until regulation catches up with reality. And I think the principal reality that you need to catch up with is that banks are operating on excessive amounts of leverage. After the Basel III norms, which have been put in place, which require banks to hold significantly more capital than they did before, the leverage ratio that is possible, that is the debt to equity ratio with which banks can operate, is 33:1. Can you imagine a non-financial firm operating at this kind of leverage and the markets permitting this sort of a thing? So this special dispensation which has been created for banks, we need banks to operate with higher leverage, but the question is, what is the kind of leverage that you can tolerate? And I think the academic view on this is that an equity level, a simple equity level, I'm not talking about risk weighted capital and so on, of about 15% is what is required, which means a debt to equity ratio of something like 6:1 or at the most 10:1. But 33:1 predisposes banks towards failure.
Absolutely. Many problems still remain. But Khan, the fact is that the Fed and the US government acted in unison despite all talk of central bank independence, etc. Whereas we see that the kind of joint action immediately after the crisis, a sense of shared responsibility for macro stability, seems to have been broken down in the Indian context, particularly as evidenced by the RBI's relatively inflexible position on power sector NPAs. Do you think that part of the reason is that for this is because the Fed has dual responsibility for both price stability and employment, whereas under the inflation targeting regime in India, we have now made the RBI responsible primarily for inflation control and everything else is secondary as far as the RBI is concerned? Khan?
No, this is a big debate whether we had gone for inflation targeting too late or too early. Time will tell. But we had earlier approach of multiple indicator approach where financial stability is one of the explicit targets along with monetary stability and growth. So we have to wait for the time to come out, but the fact remains globally, irrespective whether you are inflation targeting or not inflation targeting regime, the central banks are sort of a systemic risk managers, and they have to focus on systemic issues and financial stability issues. And in Indian context, we have FSDC, Financial Stability and Development Council. I think that has not really been tested and it's more of a coordination among the regulators, but not real action flowing from that.
That's true. Many things still remain to be done. In fact, Obik, the financial crisis is also called the subprime crisis because banks were extending mortgage loans hand over fist to subprime borrowers thanks to the US government's bid to encourage house ownership. Are we in danger of doing something similar with the government telling banks to lend for housing under the Pradhan Mantri Awas Yojana to Jan Dhan accounts without collateral to Mudra accounts? So are we going down the same road despite, we should have learned from what happened in the US? Obik?
No, I tend to agree with you, but I'm kind of conflicted because when you are walking down the path of financial inclusion, you are going into what is sort of classic subprime territory, and the deeper you go down or the further you go down that path, the more sort of subprime becomes. And so there is this, the objective of greater financial inclusion, access to banking and so on. But there is also this thing of escalating risk as you, go down the risk hierarchy of, borrowers and so forth. So I think some balance needs to be struck. I think there is evidence of some bad loans, unanticipated rise in bad loans in the affordable housing segment. MSME seems to be the next NPL area that will come under focus. So I think we need to completely rethink the model of financial delivery and not just flog our systems beyond a point and blinker them to the problems of compounding risk as they lend more and more to the subprime categories.
Well, I'm afraid we're running out of time, even though there's so much more to discuss. So very quickly, TTR, are we better prepared today? What is your sense? And what do we need to do in order to ensure that such crises don't recur, at least not too frequently?
Well, I think I made it very clear that financial regulation needs to be far more stringent than it has been so far. And one of the things that we need to do in the Indian context, which I think the RBI is set out to do, but it hasn't traveled down the road because I think of a lot of resistance from the corporate world, is to set concentration limits for various kinds of lending. Now, this is a risk management activity which has in the past been entirely left to the banks and the bank boards, but I think they have not proved themselves equal to the job, and therefore it's very important that the RBI unveil its own policy for concentration limits, which would also include limits for exposures on account of financial inclusion. So the sort of risks that you talked about having excessive exposure to subprime loans and so on can be tackled if you have a policy in place for concentration limits of various kinds. So exposure limits for corporate borrowers, exposure limits for corporate houses, exposure limits for real estate, exposure limits for the commodities, exposure limits for the stock market, so on and so forth.
Okay.
And there must be very stringent limits laid down by the RBI within which banks should be asked to operate. So I think that is one important piece of regulation on top of the other things that I mentioned, which would be required.
Okay, Khan, I think TTR keeps insisting that regulation is the key, but would you agree, would you like to add to that list just very quickly, 1 or 2 points?
No, I will say both macroprudential regulation and microprudential supervision aspects. Second is coordination within the national boundaries and across the nations. For example, government, different regulators inside India and G20 forum and the international forums, coordination across the countries, including safety nets like pooled funds or IMF's resource base and domestically some safety net in the central bank reserves. And third important point is you can't totally rely on the banking system. You need a diversified financial system, both banks, non-banks and including corporate debt segment. And the fourth and important point is some sort of a consensus in political economy that you can't stretch the financial resources in the name of financial inclusion and bring a culture which is not conducive for a good credit growth or sustainable credit growth. And in the name of financial inclusion, we should not be doing something which will cause more harm than good to the general population.
Very true, very true. Obik, what would you like to add to that list? I'll let you have the last word.
No, I'm going to be very quick about this, and I think I started by saying that economists were to be blamed for the great financial crisis because they thought, price stability was the be-all and end-all of everything. It ensured everything else, financial stability and so forth. I think we should have learned a lesson from that, and I just hope, to sort of bring it to the context that you had of the question that you had raised earlier, is the RBI too focused on its role as a monetary authority, as a price targeter, and not focused enough on the regulatory side of controlling bad debt, of ensuring that banks' balance sheets are clean. I just hope that they strike the right balance. I think they're trying to do that. There might have been overcompensations in terms of the rigidity of norms in response to earlier laxity and so on. I think we are walking down the right path, but I hope the pure macro objectives don't overshadow what needs to be really sector-specific control and intervention.
Well, on that very optimistic note, I'll have to call a period to this particular discussion because there's much more to be discussed, but we really don't have the time. Clearly, many factors, many players were responsible, and we have a long wish list from our three experts of what needs to be done if we are to prevent, if not completely eliminate, such kind of crises. Thank you so much, TTR, Obik and Mr. Khan, for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at DT Now.